to say ASS, but I changed it to awesome. You okay with that, Rob?
Yeah,
Get me keep it clean over here.
exactly. You know how I am, such an angel here.
That's right. I forgot to tell you, I was surprised that we didn't even talk about it, but we twinned it today. You and me with the black shirt.
Yeah, we did. Absolutely.
TradeThirsty hat, we'd be spot on, right?
We would be spot on, that's for sure.
All right. So our next speaker, Bob Ioaccino, a great friend of mine. And Bob, what he's going to be talking about is, he and I aligned several months back, and he was talking about what he was doing to make money in the market. And he doesn't really, sell products or share what he's doing. He's a trader, right? He's a pure trader. He's, working in the market every day and giving his commentary out to some big news outlets. I'll talk about that. But in talking about that, I was like, Bob, people want to know what you're doing. Like, why don't we just tell them what you're doing? And so we put together this idea. He's going to talk about it in this next presentation. But really what he's going to share with you is the power of how you can look at the stock market in one specific way and then cherry pick the trades that are going to make you money right now, instead of the buy and hold or looking at 50 different stocks and then trying to figure out where something I learned a long time ago. You can't have more than 10 kids, right? You can't manage more than 10 kids in a room. You can't really manage more than 10 stocks in the room. And that stuck with me. I think Tom Busby taught me that. So let me go ahead and turn it over to Bob. Bobby, can you mic up? And
I am.
Are you going to show us your mug?
You guys hear me?
Yeah.
Oh yeah,
Sounds
hear you great.
There he is. Look at him in that Roll Tide red.
And you guys, I don't ever want to follow a 10.3 again.
Hell yeah, you do. Own it.
And Bob, that was the Russian judge.
Yeah, I'm running the 100 after Usain Bolt went in the prior heat. It's like,
Raleigh, killing me, Smalls. All right, Bob, to share your swag over there.
I should be able to. See if I can make this work. I know how to work this, but we use so many different things. Wow, look at
yeah, true.
There's a life haircut. Not doing too bad with that.
All right. You see it yet?
You're gonna see me going into slideshow mode, so
yeah, it's totally fine. Look, we're all people here. It's fine.
So can you guys confirm to me that you can see this, because I'm struggling to get the chat box up. Let's go to.
I can see it, Bob. You're clear. Your crystal clear sound is good. You can just take it away.
All right.
Hey, and Bob, the questions are going to show up in the Q&A panel. So you have an option there called Q&A, and that's where the questions are going to pop up.
Got him. I appreciate it, guys.
All right, bud.
All right. So I am Bob Ioaccino, and Jeanette is right. We met at an event in New York that I was actually doing. It was Jim Cramer's Street.com. I was one of the presenters in the Street.com. So Jim Cramer invited a bunch of us. One of them was Scott Bauer. Jeanette knows Scott. She was there. And we chatted a little bit in the Jim Cramer's green room while I was waiting for my turn to present. So we had a really good conversation. And you're right. Jeanette convinced me that it was probably time to kind of let people know. Now, in fairness to me, because Jeanette is smarter, but in fairness to me, I did definitely have an idea that this was going to happen. What do I mean by this? Well, what's happening in the equity markets right now. So let's start to talk about that. And first, I have to go into a risk disclaimer. I always like to talk about what a risk disclaimer is. A risk disclaimer essentially says past performance is not indicative of what I'm going to do in the future. And then we all go on and we show you what we did in the past, which I've always found kind of funny, right? We always end up in a situation where we're telling people, hey, this is what I did before. Although if you remember the disclaimer, you can't really rely on that. And I've always thought that was kind of bull. Am I seriously supposed to keep it clean? I can't. I'm Italian. Bullshit. Because every single job out there, every single contractor, every single service person, their past performance is not indicative of their future results. So what I want to tell you about this disclaimer is what it really means. And this is the truth. Just because I had 10 winners in a row doesn't mean my next 10 is going to be winners. Past performance does matter, but you can't rely on things not changing. And essentially what these things are trying to do is shift the responsibility for the risk you take back to you, which is correct. So it's something we do in the Stock Think Tank is we treat you guys like adults, but we help you along in construction of a portfolio. So that's enough on that, but that's really what a risk disclaimer is. And you guys should understand that. Just because somebody's saying past performance and showing past performance, you're still responsible for your own situation. That's kind of the core of what we do. So this is me. I'm kind of next to my own picture right now, which is weird. But I've been doing this for coming up on 27 years now, actually. I've been involved in every aspect of the market. I'm still a featured analyst on Bloomberg, not on CNBC anymore, in a fight with them. CNN, Fox Business, Sky News, WGN, if any of you know the Superstation here in Chicago, I do them quite a bit, and other media outlets. I'm also a featured analyst on the CME Group's website. So if you go to the CME Group and you see all the videos they do, I'm one of those guys. Also do a show with Jeff Kilberg called Striking Options. Jeanette mentioned the Pure Exposure Growth Series. We just did one May 4th. We got another one coming up May 18th. These are free 1-hour shows, and it's basically just a camera watching traders talk. And we actually give out real trades in that. Again, it is a free event, so if you get a chance to see that. Notice there's only one E in Pure Exposure. Very clever and cute. And I'm the co-portfolio manager and strategist for the stock think tank. So let's talk about why I put pictures of myself up, right? Because it just sounds weird even saying that every time I have to say it. Well, it's to show you, first of all, how long I've been doing basically public analysis, which is why Jeanette said to me, you know, why do you do it that way? You can't really hold people's hands the way they want you to. So you can see down here on the right on this Bloomberg screen, I think that was 2001. I did my first one in 1999. And then these are some more recent ones. This one on the bottom left here, Toronto, Chicago, which is Bloomberg BNN, so BNN bought Business News Network in Canada, is going to come up again. But here's me with Neil Cavuto, Vonnie Quinn from Bloomberg, and then the old one, and then again here with, God, her name escapes me right now. Anyway, she's basically the main host on Bloomberg BNN. If I remember it, I'll blurt it out. But that one on the bottom left is going to come up again. Also, the Pure Exposure Growth Series, our February 18th show, you can see the title of that, Black Swan Live Trading Event. Now, if you go back and look at your charts, that was prior to the 30-some-odd% sell-off that we got in the equities. We were talking about it and we were predicting it. Here's my partner, Mike Arnold. You guys might know Anthony Grisanti, Roger Curry, Jay Soloff, you guys might know. He's actually going to be on the next show. Tony Zhang is from Options Play. Pretty reputable people. We had Jim Iorio in the last one. Anyway, I put this up to basically show you that we were talking about this happening. And a lot of you kind of want to know what just happened, right? Well, that's what we were doing in that show. So from a perspective of what I'm going to talk to you guys about now, I'm going to explain that surviving something like what just happened has very little, if nothing, to do with diversification. Then I'm going to talk about our custom portfolio and how it survived the crash. And then I'll give you guys a couple of stock picks if we've got the time at the end of this, because we sent out an alert yesterday that you guys can just have. Maybe you can have those and see how we do. But in the context of what we're trying to do with the stock think tank. So let's talk about diversification not being the answer. How many of you think that you know what a hedge fund is supposed to do? You see a lot of, and it's part of what I got into the fight with CNBC about. They talk about the underperformance of hedge funds over the last 10 years, when the stock market basically went straight up from the lows in 2009. Well, hedge funds do underperform, at least real hedge funds do, in those situations. They don't underperform by much. I mean, if the stock market's up 30% and the hedge fund is up 26%, right? That's a good thing. Now, somebody just threw in supposed to hedge, but they don't. Hedge funds, when the equity market was down 30%, they were down 9 on balance. That is exactly what a hedge fund is supposed to do. So I want you to think about something, right? If you think about your neighbor, okay, and you, if you're in a hedge fund style product, okay, and your neighbor is just a buy and holder. So over the last 10 years, say they're up 100% and you're up 81, okay? Have they made that much more money than you? Well, their $100,000 got turned into 200 and your 100,000 got turned into 181,000. They outperformed, but you're both fine, honestly. Now, what about if his 100 got turned into 70 and your 100 got turned into 93 on a down move, you're in much better shape than he is. Much better shape. Okay? And the reason is making up losses is much harder than compounding on the upside. It's mathematically harder. It's not something you could do about it other than throw new money after bad. So this is part of the reason why diversification is not the answer and why a lot of people don't understand what a hedge fund is. I ran a hedge fund while I was a co-CIO of a $184 million hedge fund for 8 years. It was called the Blackthorn Fund. We also had the Canal Fund. You can look that up. And we did really well, right? It was a low risk, low reward fund. But again, when the S&P was up 15, 20% and we were up 9, you couldn't raise money. But when the S&P was down 30 and we were only down 51 basis points, so a half of 1%, then everybody loved us, right? But all they kept thinking about is their best years are only up 9 or 10 or 12. That's the problem with what the understanding of the hedge fund is. Everybody watches billions. Don't watch billions. Don't watch billions. Anyway, moving on from there, let's talk a little bit about the history of bear markets. And we need to talk about that in order for you guys to understand what may be going on here right now and why I'm currently bearish and long. Okay, I'm bearish in the stock market and I'm long it. That's what a hedge fund should do. And that's the kind of activity that we participate in our stock market think tank. So looking at the last 4 bear markets, there's been a lot of them, right? August of 1987 was the fastest one prior to this one. The previous high in the S&P 500, 337.89. The bear market begun in October of 1987. Okay, a bear market is 20% down from a recent high. Okay, that 20% took the S&P to 270.31. The low was 216.46. That happened in the exact same month. Okay, 2 months later, we were back up. The decline from the bear market entry was 19.9%. So that means in addition to the 20%. If you look at 2000, the bear market begun in 2001, The bear market low was 768.63. The bear market began at 1242.29. Time to the bear market low, it took 20 months to get to the low of that bear market move. Time to get back up, 80 months. 08 bear market. Okay, the high was in 07, October. The low was 666.79 in the S&P 500. That was a 46.75 decline from down 20% already. And it took 14 months to get there and 36 months to round back out of it. And now we're in the recent one. So currently the bear market low is 91.86. Okay, and it only took 4 days to get there. That's unlikely to remain the case. It could, but it's unlikely. And the decline was the shortest one from that bear market entry. Now, people want you to believe that we're in a V-shaped reversal, and we might be. But for my money, looking at the worst economy since the Great Depression, it's unlikely that we don't run back down and test lows. So we're still in a defensive position in the stock think tank, but we are long. Okay? So that's part of the reason. Part of the reason, not all of it. So when people say, is this time different? Well, maybe. Okay, but look at this particular chart. This is 08. Okay? This red line here, this horizontal line in the middle that you see, is the entry into the bear market, down 20% from this upper red line. There's your entry. See if I can get a pen of some sort so I can help you out here a little bit. Draw. Okay. Here's the entry. Don't mind my jagged arrow right here. But then we pop back out of it. And then here's another entry. And then we pop back out of it again. And then finally we went up, tested it, and extended lower. But then even here, by the time we got back to the bear market price, okay, it didn't just go flying out of it, right? It didn't. It stayed there for quite some time in that area before we ended up going up and making new highs. So it's a complex situation. Bear markets are not just, oh, we were down 20%, now we're back up. So back to the point of that bottom left image I showed you on that BNN interview. You can see they're calling it ioaccino's market playbook. And I say, so we are long, right? Hang on one second. Nope, that's not what I want to do. All right, so it says we are long and hedged. We make a little money in those positions. Now this was, can you see December 17th of 2019? December 17th of 2019, I said on television in front of what I believe is about a 3 million person audience that I think it's going down and we are hedged in all our positions. Now, technically, were we hedged? Like, did we own puts? No, we didn't. We were doing exactly what we do in the stock think tank. But you can't go on TV and explain that, which is why I don't like TV as much as I used to. I never really liked it. My mom liked it. But that's the whole point of being long, but being bearish. You still have to participate. You have to, because the stock market has an upward bias. So I'll go into that more later. So how do you defend against black swans and bear markets? Well, it's not diversification. This in front of you is about as diverse of a portfolio as you can get. We've got material stock in 3M. We've got communication services in Disney. We've got IT in advanced micro devices, Peloton, consumer discretionary, energy, communication services with Facebook, financials with Bank of America, Kroger is a consumer staples. Again, DuPont, BH Billiton, BH, I can never say that, BHP Billiton, which is materials, miners, right? Here's the February 17th closing price. Now, what a lot of people do when they construct their own personal portfolio, when they do it themselves, is they buy an equal number of shares. That is also not the way you do it. This equal number of shares, well, I drew a line, but that's fine. This equal number of shares here is not the way that you position yourself, but that's what a lot of people say to do, right? Kramer himself, I talked to him. He's like, if your normal share price is, normal share quantity is 100, scale in, buy 25, buy 25, buy 25. And we had this conversation. I said, why would you consistently buy 25 of shares that have different prices? This particular model assumes two things. Number one, that you're going to lose the same amount of money if you're wrong. And number two, your exposure is the same if they go to zero. Because if you don't have a price where you think your trade is going to accelerate in the wrong way, notice I didn't say your trade is wrong, but where you think your trade's going to accelerate in the wrong way, if you don't have a spot where that is, I don't like calling them stop orders, I'll explain that in a minute, then your exposure essentially is to zero for the most part. So your exposure in each one of these shares is in this column right here. So you have a diversified exposure that's going to completely destroy this if only one or two of these stocks go down hard, because you have more exposure in those. So what do we look at then? Here's that same portfolio with the March 16th closing price. All right, March 16th closing price on this one. Notice to the right, let me go back one for a second. You had $21,000 in exposure here. Here, you're down to 14.7. You lost money in this one, right? With these particular closing prices. Let's take a look at it a little bit differently. Here's the value as of March 16th, right? Now look at this. These are actual values of these stocks. In a diversified portfolio, even with a diverse number of shares, so your exposure is the same. Okay, look at this right here. This is now that same diverse portfolio, but you've adjusted the number of shares so that you're only risking $2,000 per, okay? Again, you're still taking it to zero, which is silly, but that's fine. Look at the values. Every single one of these stocks was down, except Kroger. And I think the Kroger one, and I think a lot of you would agree, has a lot to do with the nature of why the market went down, because obviously people stocked up, so Kroger's value went up. But you have a diversified portfolio here, and it did not protect you. So that's why I say bear market, black swan, Diversification does nothing for you. Absolutely nothing. If you would have had Target in here instead of Kroger, these all would have been down. So I talk about loss as being more important than gain. And this is why. This is a chart showing the gain required to make up a loss that you incurred. So if you look at this left column here, okay, right here, if you've lost 10% in your portfolio, again, I'm talking portfolios here, okay? But it basically matters the same for your dollar amounts. If you've lost 10%, you need to make 11% to make it up. If you've lost 40%, which is pretty typical in buy and hold, you need a 67% move to make it up. The easiest way to think of that, because even though that's pretty simple math, a lot of people kind of get lost in that, and I did for a long time. Think about if you have $100 and you go to your local corner store and you spend 50 of it. You've spent 50% of your money. But now how much do you have to make with that $50 to be back to 100? You have to double it, which is 100%. So it is much more important. I mentioned it's much more important mathematically to protect the money you already have than it is to gain. The example of your neighbor who had $100,000, that's now 200, and you had 100, that's now 181. That's what a hedge fund is supposed to be doing. That's what it's supposed to be doing. So how does our custom portfolio survive? Well, a number of ways, but let's just start with why we would be long only, because that's what our portfolio is. Now, a lot of people drop off when I say this, right? Well, you're long only. I don't want to be in that. Okay, that's fine. But let me tell you why some retail traders, or most retail traders rather, shouldn't short stocks, and why you can't create a product directed at a mass retail audience if you're going to include shorts, because some traders won't have the proper permissions to trade from the short side from their broker, and they may never get it, or they may get it and it may not be approved. You may miss 5 or 6 trades. You could miss the bear market. So in order to make sure that this is a product that works for everybody, we make sure that it's long only. Number 2, some shortable stocks can be hard to borrow. You can't get them. So that limits our universe. Okay, we look at over 6,000 stocks to create this portfolio of 10 to 15 stocks. And that's what this portfolio is. It's 10 to 15 stocks whose patterns and valuations are complementary to each other. And some, if we were to include shorts, they're hard to short. So it limits the amount of stocks we can look at. Shorting stocks limits gains, and potentially you have unlimited losses, potentially. Okay, that's kind of a past performance is not indicative of future results kind of a thing. Okay, but from that perspective, if you're looking at it as what the core of the product is, well, yeah, you have limited gains and unlimited losses. All right. Time works against a short position due to borrowing interest costs. So you make 5% on a trade, but depending on what your broker charges, we've all seen that interactive broker commercial where he talks about how much you charge for margin. But it's the same thing to borrow a stock. You have to pay interest on it. So you get interest that takes away from your gain. Highly shorted stocks can produce sudden short squeezes that can cause huge rallies against the short position. Now, for those of you that are repeat in terms of seeing this webinar I've done before, I'm going to tell you something I haven't said in those other webinars. Right now, we're at a 3-year high of short positions in the S&P 500. A 3-year high. You know what that means? It's going to be really hard for stocks to go down until some of those short positions come off. It's going to be really hard. So you'll see a couple of pretty strong high volume rallies, and you could start to infer that those short positions are being covered. But it's the same kind of thing. It's a short squeeze, right? Company related news and events can cause large unexpected rallies in the stock. Okay, that hurts short positions. Generally, it's something good like a buyout, right? Or a merger. There are things that go the other way as well, but we don't have to worry about those because we're covered. Stocks can remain overvalued for an extremely long time, so timing is difficult. And the most important one, I think, there's a natural upward bias to the stock market. Every single month, money goes into the stock market, long only. So it's really the only market where the odds are actually stacked in your favor, similar to craps after the come out roll. If any of you know any of that, how the odds shift. The odds shift in craps slightly into the player's favor. Same thing here. Remember, trading is not gambling. Part of the reason I like gambling is because I don't trade like a gambler. So that's the same thing here. It's the only market, really, individual stocks, the only market where the odds actually are a little bit in your favor, because every month money comes in from 401ks and long-only mutual funds to buy stocks, regardless of the price. So the stock think tank, this was our portfolio. You can see the entry date here was March 18th. That's when we basically launched the product and we took the product into the public. Okay, so there's the March 18th date. These are all real values. You can take a look at them. This is where we were. We did a webinar that day and showed this to everybody. And we started out with a $50,000 portfolio. So why March 18th? Why that particular day? Why am I showing you that particular day? Well, here's why. There's March 18th, okay? And here is the next 2 days, 3 days, I should say, down to the lows of the bear market so far. So the reason I'm showing you that is because we entered all those longs I just showed you. And then in the next 3 days, the S&P 500 went down 6.7%. As a matter of fact, if you go to the low, it was 8.6%. So how did that particular portfolio perform? Well, the interesting part is I normally don't do this. So you can tell I don't do this because this is a cell phone shot of my trading screen at the time. This is our Excel spreadsheet, which is in our members area. All right, so now you can see the entry date here. This is as of the close, March 23rd. Right? And you can see here, I just showed you March 23rd on the chart, and you can see the results of the trades here. Now remember, if you need a quick refresher, I don't mind doing it because we're pretty proud of this, right? Need a quick refresher. Here's March 18th. Here's March 23rd. Down 6.7% on a close versus close basis. Down 8.6% on the lows. A long only portfolio can perform in a down market if you treat it correctly, if you understand which stocks to be in and which stocks to not be in, based off of criterion that is completely independent of my own opinion. That's actually a true thing, by the way. I have a fundamental opinion of something, and I throw it off to my partner, Mike Arnold, who's the chief technical strategist, and he's allowed to veto me because we have a process. If you guys hear sirens in the back, I do live in Chicago. So the actual filter, we start with 6,773 stocks. We screen them using a 9-point, is it a 9-point? It's about a 9-point scan process. USA listed companies only, low price to earnings ratio, low price to sales ratio, low price to free cash flow, low price to book, strong EPS, 5-year growth, low long-term debt to equity ratio. Stock price has to be over $5. For those of you that are trading penny stocks, good luck with that. The data shows that the vast majority of stocks under $5 go to zero. It's not my thing. I don't like stocks that go to zero. And average daily volume over 1 million shares. So that's our scan. Then we end up with however many stocks fit that, and it does change, okay, because price to book can change, price to earnings ratio definitely changes. And then when we get that screen, we take the next step. And here you're looking at, again, that scan that was done on March 23rd produced 24 stocks. We then utilize that short list, run through our technical screening criterion against each and every stock to find high probability setups. Some of that technical criteria we utilize are rotation zones, divergence buy patterns, channel breakout patterns, high probability bottoming patterns. We attempt to get our desired list of 10 stocks. Now, it doesn't always happen. Currently, we don't have 10 stocks on. Why? Well, because they didn't fit. Nothing fit. After we generate our list of entries, Other technical indicators and patterns are utilized to determine high probability stop placement. Again, we don't put those stops in the market before somebody asks. We do not leave stops in the market. People ask that all the time. Well, you could get a huge blow up. It's true in one stock or maybe two. Or if it's a huge bear market or a huge black swan event, we could get it in all 10 or all 15 if we get to 15. But there's actually something to that as well that I'll tell you in a minute. Actually, I'll tell you pretty soon because that brings us to risk. Position sizing is how we manage risk. Okay, you limit risk without limiting profit by using position sizing. Don't lose money is misconstrued. Okay, people say it and it's right, but it doesn't mean every trade has to win. You use simple math and basic probability. You limit your risk first to a specific reasonable percentage of your capital, which also protects you against a black swan or a bear market. It reduces the drawdown effect during corrections, or worse, a COVID-19 sell-off. During that whole move, we weren't in. That's how we survived. We weren't in. Our high probability stop placement got us out. Some at the right percentage, some at a little bit more with some slippage. But overall, a huge win versus the rest of the market. It reduces the drawdown effect. It limits the maximum loss to both an individual stock and to your portfolio. Again, that diversified portfolio, everything fell. In ours, some we end up staying because the stop price is further away. You look at stocks like, we just got in Hormel Foods. Okay, we bought Hormel Foods. There's one of your free picks today. We bought Hormel Foods, and it is not as volatile as a stock like Tesla. Now, we don't own Tesla. Okay, but if we did own Tesla, the stop would be much farther away than it would on Hormel Foods. Hormel Foods has got a $3 stop. Actually, that's not Hormel, but that's okay. It's still good for the example. A stock like Hormel would have a $3 stop, where a stock like Tesla might have a $300 stop. Well, does oh my God, a $300 stop, that's crazy. No, it's not. Not if your position size is the exact same, because the money your percentage of capital is the same. If you use percentage of capital to calculate risk, and I'll show you in an example, the amount you're going to lose, the amount of money you're going to lose is always the same. It never changes. You might get a little slippage here and there, but in our experience, you also get positive slippage, meaning when you get stopped out of a trade, sometimes it's higher than the stop price. And I'll explain that too. Long-term, your successful trades will win more money than your unsuccessful trades will lose. That's what's going to happen in the stock think tank. Hear that? Welcome to Chicago. So, inside Risk Our Way, well, what is the value of your investing portfolio? How much money are you using to buy stocks? And then you establish a risk per trade. And once you do that, that determines your dollar risk per trade. And then every single trade, regardless of how far away Mike and I put the stop, you're never going to lose more than you've chosen to risk on a particular trade. And that's the point. So in this example, if it's a $20,000 account, this particular person only wanted to risk 0.25% per trade, $50. That's fine. That was this particular person's risk tolerance. This is a real account, by the way. This was Aaron's. We did this sometime, I want to say 2018. The price was $44.50 on the entry, and the stop price was $40.95. So where does that put us? Well, that puts us with $3.55 risk per share. So in order to keep it to $50 of risk per trade, how many shares is that? It's 14. Now, what if this person wanted to do 10x that? Well, then it's 140 shares. What if the stop was double the size? Okay, so this stop is what? $3.45 or so? Or $4.45? No, it's $3.45. This would be cut by that amount. I'm actually going to show you guys a real example of this in a minute. But so that's how you manage these particular things. So you set an entry price, you set an initial stop, that creates the per share risk value, and that tells you the number of shares so that your risk is the same in every single trade. And that does a number of things. But number one, it reduces the danger of a single stock hurting your portfolio. You ever have that happen? I was talking to a member who's also a friend yesterday, right? He bought a pharmaceutical stock, didn't work out. Overall, he's doing well, but this one stock is hurting him bad because he's not balanced on the risk side. Everybody looks at how much they can make. Nobody looks at how much they're going to lose. So I'm going to put this slide up, all right, talking about what my followers are saying, but I want to go into the actual website and show you what I mean about position sizing. So if you guys can give me a minute, it's going to take me a minute. Actually, I'm sorry, but I'm going to stop sharing this for a second because it's just easier for me to go through and look at the actual website if I don't have to try and navigate it without you guys seeing what's going on in the background, which is really unprofessional for a guy in a red t-shirt. Hold on, and I want to share. Where'd it go? Are you kidding me? Where'd it go? The members area looks like, okay? We send out alerts, and those alerts come over email. But basically, here is what the alerts page looks like, but they go by email. Here, I'll read these to you. These are your free trades for today. So if that's all you're waiting for, enjoy. Entering a buy order in KHC at 29.45 or better, the initial stop's 26.45. So that was the $3 one. Okay, it was KHC. So we're entering that today at this price or better. These are what the alerts look like. Okay, this is exactly what people see, but you get them in your email, and then you could look here if for some reason, I don't know, it went to spam or you're not around your email for some reason. You could log in the members area, and all the alerts are here. So Kraft Heinz, we're entering that at a price of $29.45 or better. And we're going to get out if it closes below $26.45. So that means if it were to close below $26.45, the next day we would sell it on the open. That's it. And it's that simple. Now we've also got a buy in STZ. All right, these again are your free stocks for the day. You're welcome very much. So we got a buy in STZ. This went out yesterday. That's Constellation Brands. And that particular one is 165.50 or better. You could get that right now. Actually, I think it's about 165 right now. And see how the initial stop is 148.95? Okay, so that one is about a what? For 149, 550, 550, about a 557. I'm sorry, 560, $555 stop. Where the other one, God, where's my brain today? Do that math for me, somebody, would you? Anyway, you're looking at about, what the hell was that? All right, sorry about that. So anyway, you're looking at a $3 stop. Versus a $17 stop for the most part, right? So let's go back to, I don't think you guys are you guys seeing it? Yeah, you're seeing this. So in the position calculator here, that's where you would enter these things. All right, so we'll just stick to Kraft Heinz. All right, so let's say you have a $10,000 portfolio. All right, and let's say you've decided your risk per trade is going to be 2 shares. All right, I'm sorry, 2%. I apologize. That's $200 risk per trade. So we said the price was $29.45, and the stop price we said was $26.45. You're entering 66 shares of Kraft Heinz. Okay, 66 shares. Look at what the actual risk is, 198. By the way, that's another thing when you get some slippage. In a lot of cases, this $3 stop won't actually end up being even. So we round down as opposed to rounding up. So on most trades, you'll lose less if we get stopped out than your actual allocated risk per trade. Okay. So 66 is your position size. Well, what if you say, hey, my buddy is a little bit more risky than me. He's 5%. Okay. And he's doing 166. $198, $500 risk per trade. What if it's, I don't know, 2%, but this particular person has a $30,000 account? 200 shares, exactly 600. Now let's use a different example by going back to that $10,000 example, right? With a 2% risk per trade. What most of you would do is say, I'm going to buy 100 shares, or I'm going to risk $1,000. But with this, your risk is managed by the percentage and your portfolio size. So what happens then? Okay, so we said we're doing 33 shares here, right? 1% on 10,000, which I think I said it was going to be 2%. So let's stick with that. All right, 66 shares, 198. What happens if you have 5 winners in a row? And let's say you're now at, I don't know, 12,000, and that trade's issued. Your position size changed from 66 to 80, but your risk per trade didn't change at all. That means you're compounding. Okay, you're now adding more risk from a perspective of shares, which means you're adding more profit as you win. But what does your risk do? It stays the same on a percentage basis. Now, here's the most important thing. If you're at $10,000, let's say you lost $2,000, right? 8,000, 53 shares. What happened to your dollar risk? 160. What happened to your percentage risk? It stayed the same. And that's the point. Okay, that's actually the point. When your your percentage risk stays the same all the time, you're then in a situation where you can control how much one particular stock affects your portfolio and how much the overall portfolio affects anything else you're doing. Because if you're 2%, let's just say you're 1% on 10 stocks, you're 10% maximum drawdown, period, until you start putting on new ones. And this protects you on the way down so that as you're losing, you lose less. And don't let anyone fool you. You're going to lose. You're going to have losing streaks. But when you do a portfolio style method and you actually use professional risk metrics and management, you end up in a situation where you start to understand that just because somebody bought that stock that tripled, they're actually not necessarily doing better than you. They're taking more risk and making more. That's true. And by the way, I didn't watch any of these other presentations except the end of the last one. This particular product does not stop you from doing any of the other ones because this is a core portfolio product. The whole point of this is to build a portfolio over a number of years that outperforms the S&P, and that's what we're going to do, but not just to the upside, to the downside as well. To the downside as well. And that's the point of this. And that's what you get here when you're looking at this position size calculator. And I already showed you the alerts. The alerts have the entries, they have the exits, and they have the target. Everything's in there. Now, could you learn to do this yourself? Sure. I encourage you to do that. If you don't join the Stock Think Tank today, I encourage you, as a matter of fact, I kind of beg you to learn it yourself. Because it is critical that you understand risk and that you allocate risk the way I'm telling you. This one up here is Nick Bovell. I think you can see my PowerPoint again. Nick actually is somebody that I taught to trade through an old service I had before I stopped doing that. And here is his email to a friend in 2009, where he said he was going to take an online Forex trading course. If you look down here, he sent this to me recently. He's now the chief investment officer at Bovell. He's now a hedge fund manager. Okay, that's what he is. And this is Mimi. She's a member of the service now, talking about a couple of the trades. Actually, this oil trade wouldn't be part of the service. It's just something we did. So I'm happy to take questions, but I'm going to tell you guys that we just launched this. Okay. Currently, we are outperforming the S&P. All right. We are after today, we might be slightly underperforming, but we are long. But again, we're covered and we want to be covered. But this is the first time I've done a product like this with my partner, Mike. This particular product with this particular filter, first time we've done it. Okay, we did a product like this that was a similar style, but I wasn't really happy with a lot of things. We haven't had any other sort of product since about 2009. And the reason we launched this now is because of what happened in the markets. That's why. So this is an introductory price, and it will go away. Okay, it will go away. So again, first bunch of people, I don't really even know what the number is. We're going to raise this price. You're going to be able to come back here and see that this price is now gone. All right. I'm going to start going to questions. All right. I'm going to start going to questions on this, but I'm going to continue to kind of walk through what the actual stock think tank is as the questions come up, because this is the part I have to tell you guys, I'm not a salesman, but I promise you this price is going up. So if you can join now, you should, because this is $41 a month, basically. So currently somebody asked if we have a monthly option. No, we don't. And the reason is you have to be in it for longer than that. I'm sorry. You can't say, I'm going to be in for 2 months and quit, because it takes away the point of building a portfolio. So no, there's no monthly option, and there's not likely to be when the price doubles or triples or wherever it does go. I know you guys hear that kind of crap all the time. This is an introductory price. We launched it in March. That's it. You take my word for it. All right, let's see. I want to answer this here. Using percent gain required to make up loss is misleading. The dollars lost and to be won back are the same either way. That is true. Okay, hang on. Let me finish reading this. And again, I want to show you that I'm not afraid to address these things. Using relative percentage loss and gain makes it seem like you must gain back many times more dollars than you have lost, which is not true. This scares traders into not making trades because they infer they have to gain back many more dollars than they originally lost. Just wrong thinking. I couldn't disagree with that more. And I'll tell you why. Because when you have lost that money, you have less money to operate with. It's the loss of money that makes people stop trading. My whole point for doing this for 26 years and running a hedge fund is that you need to operate based on percentages, because percentage takes that fear away. If you're risking 1%, you're risking 1%, whether that's $50 or $500. If you're actually going to come here and tell people they need to continue to risk the same amount of dollars in order to make that loss up, we just have a fundamental disagreement. I'm not trying to scare traders. I'm just trying to show traders how they blow up, because that's what happens. The percentage gain is all that matters. Otherwise, you'd hear all these hedge fund guys and all these other people saying, I made $17,000 today. Well, how much did you risk doing that? I made $6 million last year. Well, did you risk 26 million to do it? I made 100 million. Well, did you do that off of a 3 billion account? Percentage is the only thing that matters. And that's the way professionals trade. So again, I get pretty passionate about this. I think we just disagree, but it is true. And I said it in my example, by the way, if you listened, I lost $50. I have to make $50 back. That's the same amount of money, but I have less money to do it with. Is it easier to turn 50 into 100 or to turn 100 into 150? It's easier to turn 100 into 150. So anyway, I'm Italian, so I come across as angry. Jeanette will tell you, I'm not angry at all. I'm just extremely passionate about this because it's one of these things that people, they're not wrong. Whoever put that in, because I think it's an anonymous person, I couldn't really read that comment. Whoever put that in is not wrong and is not trying to be an asshole. I'm positive. It's just, it's the wrong way of thinking if you're going to trade a portfolio. It's just incorrect thinking. It's not a wrong mathematical equation. Anyway, I should go back to this. I get caught up in this stuff. Okay, where am I going to start here? What will the price go up to after the period? I don't know, because that's up to Jeanette and those guys, but it's going up. I don't want to do this for $41 a month. Okay, I barely made it onto this webinar in time because I could show you my screen. You could see my board behind me. I got stuff to do. So we don't want to do it for $500. I don't know what it's going to go up to, but Jeanette convinced us that we should do an introductory price, and that's fine with me. May I know the lifetime price? I don't know what that is either. I really don't. So somebody, Gary asked if it's a trailing stop. We do use trailing stops when we're bullish. We also have a private thing we call the bear market think tank. So when the bear market think tank sees a bullish trend, we use trailing stops. Right now we use targets, which are, thank you, Haley, by the way. Haley says red is one of his or her favorite colors. I don't know what that is. We use trailing stops when we're in bull market mode. Right now we're in bear market mode, so we use targets, okay? So the targets are right now. By the way, guys, a target doesn't mean you exit, okay? A target is a place where an action is required. Sometimes that action is to move a trailing stop up. Other times that action is to cover the position. Now, the second part of this answer is that when we start to make money on a stock, we trail our losing stop up as we follow it. So we use trailing stops to protect ourselves again. We're always trying to protect ourselves. About 80% of our trades get stopped out for less than the full risk because we're trailing that stop. So that then goes into the protection part of the stock fin tank as well. Okay, remember, I didn't watch this, so this doesn't prevent you from doing options and scalping and anything else anybody else is doing. This is a core portfolio. This is what I can do for you guys. You guys want to trade crude oil futures with me? I don't think you do. I really don't. I really don't. So anyway, thank you, Jeanette, but I didn't write down the offers. Oh, somebody wants a list of offers, Jeanette. I don't know if there's an answer to that. Do you sell tools to self-manage existing portfolio with good trading practices, risk manage, and position rebalancing? Not currently. We don't. Not currently. So, but we do. You could theoretically learn what we do here and do that. But no, we don't do that right now. We're not money managers anymore, and we're not financial planners. This is a core portfolio for active investors. If you want to be active and you want to act like a hedge fund, this is where you want to be. If you don't, totally understand. Totally understand. What else we got here? Give me questions on anything. By the way, did you guys watch yields today? Another reason why I'm bearish, is because yields are collapsing. The 10-year note fell by 9 basis points in the last 3 days. The implied Fed funds rate for December of 2020, it's a mathematical equation, don't worry about, is negative. So yields are falling. That might spook the stock market a little bit if you combine that with the gold rally we've seen. I may have missed it. Do you put your stops in the trading system or use mental stops? Jim said, that's Jim. We don't use mental stops. We give you the stop when we give you the alert. We do not enter them into the market. My partner, Mike, tested multiple systems. By the way, Mike is a hedge fund consultant he's a full-time consultant for hedge funds. Of all the systems he's tested, about 98% of them work better if you just wait until your stop gets closed below and then exit the next day on the open. So you will know what the stop is. So for example, in that Kraft Heinz trade, our stop's 26.95. If it closes at 26.94 on any given day, the next day we'll sell it market on open. Hopefully that answers your question. All right, how much minimum capital needed to correctly diversify? Again, this is not diversification, Paul. You want the 10 stocks, but they might all be in the same sector. We don't know. It's all about our criterion for picking good stocks. We're not trying to diversify, but you should have at least $15,000, but you don't have to have that much. I've got a client that has 7 figures in this. I've got a client that has 100,000. I've got one that has 5,000. Because that calculator works the way that it works, if there's too much risk in a trade, in other words, the stop is too far, okay, like maybe that Constellation brand, that $17 stop or so, you'll get a position size of 0. So that just means you can't enter that one. And by the way, don't enter it if that happens, because that's then the one stock that you're going to have too much risk on, and it's going to blow you out. So you don't want to do that. So I think I answered that question. By the way, guys, I'm kind of flying around the questions box. So type in your question again if I haven't answered it yet. Please, can you let me know what sectors have the most liquid stocks? I'll tell you, there's liquid stocks in every sector, Chuma, in every sector. I would say the least liquid is the smaller stocks in biotech, but don't quote me on that because there's basically 11 to 13 key sectors. There's 6,700 stops, okay? Bob M wants me to go back over how you select the stocks. I guess I can do that really quick. I'm going to put this up, Bob M. And do you mind taking a screenshot of it? Here's the initial screen. Okay. If you don't mind taking a screenshot of it, I just don't want to read over this again for the people who don't want to hear me read it again. All right, so I answered the minimum capital question. Does it also support Forex trading? We do not do Forex trades at this point. No. Are stops based on underlying volatility? That's a very broad question. Stops are based on several factors, significant levels, prior support and resistance, static rotation zones. It's our own basically proprietary process. Eventually we might teach it, but I don't want to do education right now. If you guys want us to sort of manage this portfolio for you, this is the product that we have for you. Okay, hopefully you took your screenshot because I'm going to get rid of this slide. All right, this is May 6th. That was yesterday. I should have changed that. So obviously we don't have a May 6th workshop. I think our next workshop for members, I want to say it's the 12th. I think it's May 12th, our next workshop for members. Those are member workshops. So you got to join today to get in that. All right, Bob M., did you get that? I hope you got a screenshot of that. Do you sell tools? I saw that one already. Okay, I've got 1 minute, I think, or did I go over? No, I've got 1 minute. So if there's any questions at all, I don't care if they're market related or not. Can you show the percentage portfolio analysis? Percentage portfolio. I'm not sure what you mean. Basically, I'm not sure what you mean by that question. Can you show the percentage portfolio analysis? I would just tell you that we balance our portfolio based on risk. So when we find our stop prices, we then calculate how many shares keeps our percentage risk balanced, okay? All right. Thank you, Lindsay. Lindsay is telling me not to get so animated. I get animated. Sorry, I respectfully disagree. To an inexperienced trader, losing 100 or 100% does not require winning back 900. That's not what I said. PRF, that is not what I said. It is about the capital you have to make those returns. And when you lose it, you have less. It's just that simple. And you can respectfully disagree. That's fine. I have no problem with that. We have a respectful, we disagree. Where are the updates given? The updates are given in the members area and via email. How often are new stocks added to the portfolio? We send out alerts every single day. Maybe twice a week, those alerts say no action to take, maybe once a week. And then other times, there are trades, because we have a limit price on our orders, there's trades we put out, but they didn't get elected, they didn't get triggered. So we'll tell you to cancel those. You get alerts every single day. Probably get new stocks a lot more in bull markets, which is right now. So it's probably, I would say, an average of 2 to 3 times a week, you'll get new stocks. But essentially, a lot of the times we might have the portfolio full. Other times we might go for a week or two with just 2 or 3 trades on. So just wondering how many stocks have free cash at the end of April this year. The end of April this year, we were in 4 stocks of the 4 and 2 special plays. Anyway. Jeanette is back on. She's taking her hat off. Can you put your spreadsheet on again? I think I've lost. I have a hat somewhere. It's not here. Here, can you give me 1 second while I get my hat? I'm going to get my hat. Watch this hat. Hang on. You know, a lot of people don't even know what this is, but this is the Chicago flag. Like, Chicagoans are really weird about the Chicago flag, but we have it everywhere. So anyway, Jeanette, I can't hear you.
I was just talking away. Couldn't hear me. Just talking away.
So, by the way, I got one last question I want to answer. Can you guarantee performance? We're going to outperform the S&P. Okay, especially when it's down, but over time when it's up, that's what we've done historically. And that's my guarantee to you guys. What else? Anybody else? Otherwise, it's a very handsome man. I didn't see who it was, but very handsome man waiting to go on. Oh, it's Raleigh. Okay, good.
Look, Raleigh got his hat on. We're macking out over here. Just trying to keep up with each other.
Absolutely. I got my hat on here. You can write anything you want up here.
That's right. Thank you, Bob. I appreciate your time today.
Yeah, so again, really quick, just that May 6th is wrong. That's a members webinar, and it's
That's fine. If they buy today, I'll make sure they go through support, and we'll get them what they need.
Cheers, guys. Thank you very much, everybody. Talk to you guys soon.
Bye-bye. Take care, Bob.